Well, good morning, everybody, and welcome to our webinar. We're going to be dealing with M&A, private equity, and deal trends in the Northeast. This is one of the Brodies 10-year in Aberdeen celebration webinars that we're holding. We are very proud to have been in Aberdeen for the last 10 years. We started in Colin McLaren's kitchen, and we're now the biggest law firm in Aberdeen, which is some achievement over 10 years. So we are, as I say, very proud to have got this far. My name is Doug Crawford. I am a corporate partner at Brodies with 30 years, unfortunately, experience of mergers and acquisitions and private equity. I'm joined today by two of my partners, David Millar and Martin Ewan. David has 20 years of M&A experience and specialises in oilfield services. Martin has probably just as much experience, but actually as a wider discipline. He is M&A, a bit of upstream oil and gas, technology, contracts, and I'm sure he's well known, as is David, to many of you. We've also got two guest presenters today. Mike Beveridge, Managing Director of Simmons Energy, who again, I'm sure many of you will know, and equally Matt Anstead, Senior Partner at Energy Ventures. The agenda, we're going to talk about four different things. David's going to lead by looking at how the region has reacted to some of the macro events that have taken place over the last few years. Steering away to an extent from oilfield services and just looking at the wider M&A deals business economy. Then Mike's going to lead us on oilfield services, an overview of where the M&A markets are for oilfield. Martin will then take us through developments in technology, what impact technology is having, especially in the energy sector, but it could stray across into other sectors too. And finally, Matt is going to deal with energy transition, the movement to net carbon zero, probably some aspects of government regulation in relation to the financial services sector, which would impact PE, and shareholder sentiment as well in relation to investing in carbon. I do suspect that what Matt has to say might overarch everything else that we're going to deal with, but we'll just take it as we find it as we go through. So with no further ado, let's dive into the first section. So David, I mean, Brexit was a big thing, but arguably from my perspective, it might not have had a huge impact on the business community in the Northeast. However, we've also had India Ref 1, we've got potential of India Ref 2, we've got climate change, we've got oil price volatility, which even if it's not related to oilfield services, is going to have an impact in the Northeast. And then we've had COVID. So we've had an awful lot of macro events. What's the sentiment? What's been going on?
Thanks, Doug. So I mean, I think the most obvious place for me to start would be COVID. COVID has had a significant impact over the last 15 months on many of us in many different ways, particularly in relation to M&A. When I think back to March last year, obviously no one really had any idea of what a global pandemic was. We hadn't really been through one before, and so when we entered into the first lockdown, we saw a significant impact on M&A activity, as you might expect. I personally had 4 deals which were live at the time, all of which paused and sadly ultimately didn't happen because of COVID. A lot of businesses had to hit the kind of pause button, if you like, take stock of what COVID actually meant to them, how it affected them, and it took a while for businesses to adapt to that new environment. And but nevertheless, after getting through the initial shock of COVID, as we went through into middle to the later part of last year, we did start to see a bit more of an uptick in activity. Some of it traditional M&A, but also quite a lot of restructuring that was going on. I think businesses and to a certain extent private equity funds were looking at what they already had, and that drove quite a bit of activity in terms of restructuring of funds and restructuring of businesses. And I think when we went into a sort of second lockdown, people understood a little bit more about what that meant. People had to adapt, had to change to get used to working in a global pandemic world. And so we continued to see a bit of activity there. And as we've come out of the second lockdown, with a potential third lockdown looming, who knows, none of us have got the crystal ball. But again, I think businesses generally are better adapted now, understand it, a bit more comfortable with what it means. And I think we'll come on to talk about some of the opportunities that will be thrown up in the next 12 months with things like energy transition and the innovative new tech. There's obviously some sectors which have been hit a lot harder than others, and it continues to be a very difficult period of time for them. The likes of retail and tourism and hospitality continue to be hit hard. I think the other thing that I would say on M&A, I guess deal execution and how COVID has impacted that has changed the way we've had to work a little bit. It has some practical implications for due diligence, for example. The traditional site visits are a lot more difficult. Interaction is almost entirely virtual now, and we lawyers have had to embrace change when it comes to the execution of documents, for example. Something that if you'd asked me 2 years ago whether I'd be completing all transactions using DocuSign or Adobe Sign or whatever it is, I would have told you I didn't know what they were, but we've all had to adapt. Some areas still, I think, there are certain parts of the law where you still need wetting signatures, but it's changed the way we've worked. But nevertheless, I think everyone has adapted. All advisors have adapted well. A lot of the businesses have adapted well to the virtual world we live in now, and had to. I think on Brexit, as you mentioned, that I personally haven't seen a significant impact on M&A activity as a result of Brexit, whether that's because everyone had a little bit more time to plan for Brexit. They knew a little bit more. Okay, I know that it's a little bit last minute before we knew what it looked like when we did exit, but perhaps the fact that people had plenty of opportunity to plan has made a difference, and there are some practical implications of Brexit when it comes to legal due diligence, for example, but I haven't seen a significant impact on M&A activity. Yeah.
Well, interesting. I mean, I certainly came across a couple of companies where through Brexit they opened up branches in Europe to deal with export, which was disappointing but inevitable. Matt, just picking up on something that David said there, private equity generalists must have found COVID very difficult, because presumably all sectors were getting damaged by the impact of COVID. Whereas, I mean, you can see with oil price fluctuations, oil and gas investments get hit, but this time around with COVID, presumably the private equity generalists are having a hard time and therefore focusing inwards on their portfolio rather than looking for new investment.
I think that's right. I think that COVID did cause investors to have to spend more time focused on fixing parts of their portfolio, supporting management teams, for sure. I would say, there was definitely for sort of 3 to 6 months of last year, a sort of slowdown in deal flow, and execution became a bit harder. But I think we're through that now, and I think that things have stabilized. I would say actually last year, and I was in the States, living in the States until about August last year. So my experience was a little bit different to sort of what it would have been if I was working on investments in the UK. But we did spend a lot of time with portfolio companies dealing with the provision of support from government, and that was one of the things which help some of our portfolio companies get through that very difficult time. But like I say, I think we're through that now, and in some ways we're back to where we were, in the sense that there is a very buoyant market for M&A, hugely buoyant. But I still think that's not necessarily the case for oilfield services. That market has been thin for a number of years now. And I'd be interested to find out what Mike thinks about deal volumes, comparing what you would call traditional oilfield services to businesses that you would associate with energy transition.
Well, before we let Mike loose on that one, because that's going to be an interesting topic. It's been interesting, Martin. I've noticed that there's definitely winners and losers out there. There are certain segments of the M&A marketplace that have done very well. I mean, we came across a cloud computing business that just took off on the back of COVID, and call centers not being able to operate, then everything migrated to the cloud. Have you seen quite a sort of evidence of that type of activity?
Yeah, well, in some ways, I mean, without wanting to jump onto the stuff that I'm going to talk about under the technology heading, I think that's absolutely right. There are winners and losers, and what it is demonstrated is that for most of your mainstream SMEs in Aberdeen, if you were not able to embrace e-commerce and did not have a credible online platform and sort of deliverability solution for your customers, then you were snookered. And it's as simple as that. It's a very Darwinian whirlwind that hit. So yeah, I mean, in terms of M&A activity, to be honest, we haven't seen. I suppose that's a general business observation. I don't think we've seen that much M&A activity generated from it. We also curiously didn't see the amount of insolvency-based restructuring that we expected. I guess you've got it's a bit like the corporate undertaker. You expect them to be busy in bad times, but we didn't see that either. And I think that was a mix of the government furlough support and so on, keeping things dripping along on a sort of zombie basis in some cases, just generally there wasn't the buyer appetite either. So one comment that David made about the deal execution piece, it's amazing how quickly the banks have adapted as well, because you think lawyers are old-fashioned, try opening a bank account. So it's all the electronic ID certification and accepting documents electronically as well. So I think it's catapulted us forward, which is a good thing for the 21st century.
Yeah. Okay, great. Well, I think that's probably all we've time for on that first section, to give us a chance at the others. So Mike, on OFS, what's it looking like from an M&A perspective at the moment, and what's it looking like going forwards?
Yeah, thanks Doug, and thanks everybody. Well, I think there are some of the comments already been made, but hopefully I have one or two other observations. I mean, needless to say, the last 12 to 15 months have been really difficult for M&A in OFS, and I think for obvious reasons, everything basically came to a stop. Anything that we were working on, or anybody was working on in a pre-COVID world, was never going to get done in the face of the storm that hit us in April, May last year. And people become inwardly focused. Transactions get put on hold, business plans get thrown out the window. But looking back over that time frame, deals have got done. So it's not like there's been a lack of M&A, a complete lack of M&A. People have got deals done despite the market. And I think since the start of 2021, we've seen a noticeable pickup actually in M&A activity generally, probably surprisingly so. And I'm going to talk a bit more about OFS versus other sectors, but within OFS, a surprising pickup. I think buyers who are through the worst of COVID now starting to see a recovering sector wanting to take advantage of it, and sellers probably more willing to explore deal options because there'll be a belief that sellers can get some sort of value or realistic options for their business, which would not have been the case back in the summer. I think oilfield services itself, as a sector, COVID taught us that it was remarkably resilient. Just relative to the sectors that you just alluded to there, Doug. That oilfield services has performed pretty well, and if you're a banker or an investor in the sector, you've done okay, in terms of operating performance, because businesses have learned to cope with COVID. The industry proved itself to be critical. People managed to work around a lot of operational challenges, and the businesses have, I would say, the sector as a whole has performed surprisingly well. I think if you looked at the forecast the sector would have put out in maybe April, May, June last year, relative to what they how they performed for the year as a whole, with the benefit of hindsight, I think generally the sector, surprised itself and had a much stronger summer and second half 2020 than many expected. So I think we've got a sector that's in operationally quite good shape. The challenge that we have is, there's a disconnect between operation and operational outlook and M&A activity, because the two are different things. And I always make the point that M&A activity is something of a discretionary item. People don't have to do deals. Doing nothing is always an option. Companies have got plenty of operational opportunities and challenges. They don't have to do M&A. They can pursue growth in other ways. They can pursue growth organically. And a lot of M&A activity that we've enjoyed over many years has been, I suppose, if we're honest about it, it's passing the parcel, isn't it? It's companies moving from one private equity group to another to another to another. There's plenty of Northeast businesses that have been through 3 or 4 sets of private equity owners over time, and people have hopefully made money on the journey. But those deals are options. There's an optionality around those deals rather than a sort of imperative. I think. I want to touch on the macro, because that for me, that is so critical to how people think about things. So what I think is most interesting is the rebound in oil demand. And most of us would probably have predicted it, but reading some of the stuff in May last year, you would have thought the world had ended, and people were making decisions based on very short-term data. But the IEA just came out with a report yesterday, which predicts that oil demand by the end of 2022 will be back to pre-COVID levels. So we'll be back at above 100 million barrels a day of global demand in Q4 next year, based on predictions. And that those could be conservative if aviation demand comes back even more strongly potentially. So we've got line of sight in oil demand back above pre-COVID levels, and oil gas services industry that's been decimated, and it's going to have to function as a business, as an ecosystem, in terms of an industry that's going to be, coping with demand increases of over 5 million barrels this year and over 3 million barrels next year. So those are big recovery factors that the oilfield services industry is going to have to support. So I think we can see an industry shaping up to have a pretty strong recovery period over the next 18 months. Oil prices are sitting at around $70. That's a great oil price. That's a price that produces fantastic cash flow for the operators and producers. And with supply chain costs having been significantly hammered in recent years, there's a strong margin for many developments at that sort of level, which incentivizes new activity if the capital is there to do it. We're seeing capital flowing into the industry through independent E&P companies, notwithstanding all the fossil fuels agendas at the IOC level. So there is a desire on the part of operators to make acquisitions. From an upstream perspective, make acquisitions and pursue new developments. So, talking to some of our clients in the North Sea, for example, 22, 23, 24 could be quite a busy period in our basin in terms of drilling activity, workover activity. There's a lot of development wells to be drilled. There's a lot of workover activity scheduled, and there's obviously a big P&A market to be pursued. So I think we have a strong macro, and I think the challenge that we have at the moment is trying to sort of deal with the contradiction, I suppose, between a strong oil price, quite a strong macro environment post-COVID, high demand levels filtering through a lot of the oilfield services clients we deal with. But on the other hand, this very strong anti-fossil fuels agenda, that's driving investors away from our industry and making people, you know, reluctant to commit to long-term decisions.
Yeah.
And you know, there's one, is lots of phrases that kind of stick in our minds, but talking to a very well-respected but now retired private equity investor, somebody all of us know of by reputation, who no longer works in our sector. But his comment to me 2 months ago was that the challenge with oilfield services is that if you're a private equity investor making a bet on the industry today, you don't know what the terminal value of that investment now is. You know, whereas, you know, for the last 25 years, we've all been used to advising on deals or in private equity investing in deals, with the acceptance that our industry is cyclical, but we've always had a fundamental belief that if you build a business and succeed operationally, you'll have exit options, and you'll be able to sell, sell that entity for, you know, a strong multiple of EBITDA. If you start to question the terminal value of our industry, and ask yourself, who's going to buy the business that we're building in 5 or 7 years' time? What is the terminal value of that business? And you start to rethink that assumption, then you know, it drives some pretty conservative thinking in terms of what would you pay for an opportunity today. So, you know, so that is a real dilemma, and I think, you know, I've always got more to say than we have time available. But one more point before we kind of open it up. I think, you know, the pendulum for me swings all the time. So we've had a very difficult, sustained downturn in oilfield services post 2014. We all recognise that, and we lived through it. The upturn never really came unless you were in US land. But we got through that into a new normal before we were then hit with COVID. I would say during COVID, as a result of COVID, potentially, well, I think it's linked. You know, we have even a stronger pursuit of climate change agendas than ever before. It dominates the G7 conference in Cornwall this week. You know, we've got, you know, lobbyists, challenging the decision making and board constitutions of the major oil and gas companies. So we've a massive fossil fuel lobby working against the industry, and we can all debate the rights and wrongs of that. But this pendulum therefore swung back so strongly over the last 15 months. It became almost very difficult to see how you could actually dispose of an oilfield services business in that challenging market. And I think, thankfully for us, for me, for the industry, I think we're starting to see this pendulum swing back towards a degree of common sense. So I think what we now have sitting here in summer of 21 is hopefully a more balanced view that, yes, you know, we're in a energy transition, which, you know, is the beginning of a long journey, and and the word is transition. Oil and gas plays a big role in that transition, and therefore the supply chain, is critical to that transition. And we're going to have to deal with oil demand increases before we deal with peak oil demand and some sort of sunset industry at some distant point, hopefully in the future. So investors that start recognizing that pendulum swinging back, I think, can make more informed decisions and be willing to, you know, buy businesses on their merits based on financial performance and prospects, rather than some greater fear that our industry is going to lose its license to operate at some point in the foreseeable future.
Yeah. No, thanks, mate. That's excellent. I mean, what the two things going through my head are, what are seller expectations like? I mean, are they becoming reasonable, and who's going to buy? So, well, I throw that one out. David, what's your thought on seller expectations at the moment?
I think seller expectations perhaps have lowered a little bit. I mean, it's been a difficult few years, obviously, and sellers' expectations have kind of peaked and troughed a little bit, I think, with the various macro events. I suspect that they are probably slightly lower than they used to be. The difficult question, I guess, is who's going to buy, and I don't think I have an answer for that. Not an obvious one anyway. One of the observations that I had, that we've both, Mike mentioned it as well, talked about transactions that we had that were live pre-COVID. One of the things that we are starting to see is some of those transactions coming back to life now. Slightly differently structured, but they are beginning to come back, and I was wondering if anyone else had any experience of the same thing happening.
Yeah, I think it's quite telling. I mean, there's definitely more of the pipeline M&A transactions starting to move towards actual transactions. So I suppose that does show seller expectation must be getting more reasonable, and it must show there are buyers. The one thing I wouldn't say we've got is private equity buyers. It seems to be mostly trade. I don't know what people think about that.
I'll maybe say a couple of things about that, Doug.
Yeah.
So we've got about 22 portfolio companies that are oil field services. Well, let's call it 20 oil field services companies that we're majority shareholders of, pretty much. And we need to monetize those investments at some point, and we're working very hard to do that. And so often we're sort of hoping that as Mike was sort of talking about, this recovery and a tightening in the market, that's going to be good for our portfolio companies. And we're looking at transactions where we're trying to consolidate technology companies to create larger companies with differentiated technology that produce, with cash flow. And, in the belief that makes them saleable. And quite often we're talking to strategics, and Mike mentioned, that we've been in this downturn since 2014 and never really recovered. And then you've got sort of COVID off the back of that. And then this big question mark around what the future holds for the industry. What you can say is that for the larger players, larger mid-size oilfield services companies who've traditionally been the buyers of the companies that we've invested in, that they've had, they've done a lot of sorting out. They've restructured 3, 4, 5 times since 2014, stripped out a lot of costs. And as the market tightens, they should be in great shape to undertake M&A, get back to, acquiring technology companies, which is how companies like Schlumberger have tended to add to their technology portfolio. It's less about developing that themselves and more about acquiring it. So we're hopeful that that's the case, but nevertheless, the market is still quite thin to sort of pre-2014 levels, and buyers are looking for bargains. I mean, even if you've got technology and cash flow, the valuations in oilfield services are pretty challenging still. Now, do I see that changing over the next couple of years, given this sort of market tightening that we expect to see? I'm not sure I do. And I think that that's because of general investor appetite for, hydrocarbon related businesses and the amount of, investment that's flowing into the industry as a whole. I think, I think the money is going elsewhere, and there are lots of different reasons for that. But I think it's a very dramatic shift. And, just a closing thought, I'm sorry for hogging the airwaves, but, you talk about a sort of a new normal. I think that the new normal is all about carbon emissions reduction. I think that impact over the next 20, 30 years, 40 years, we'll have all forgotten about COVID and Brexit, things like that. But our climate change and our ability to deal with climate change by reducing carbon emissions, that is a mega trend, which will, make some of those other things seem less significant, I believe. And that, that is what is, I think, will kind of put a bit of a dampener on sort of near-term, medium-term M&A activity, as sort of investors kind of scratch their head about what does the industry look like in 10 years from now, and that question around terminal value.
And just a follow up to that, I mean, that obviously has an impact in valuations. But if sellers see that and understand that and are willing to accept a lot less, does that overcome the obstacle? Do we still see then a lot of businesses exiting just at lower values?
Can I say something about that, Doug? So yeah, I think it absolutely does. So I agree with everything Matt said. Valuation has changed forever, I think, just to make a bold statement. So that I'm not, my positive narrative was relative to 6 months ago, rather than born out of kind of naive hype, I hope. So I think we're in a new normal where M&A in oilfield services will get done, but I think the valuation frameworks have changed substantially and fundamentally, and I think so sellers do need to recognise that. And I always recognise that if you're a corporate finance advisor, your job is always to broker the unrealistic gap in valuation between buyers and sellers at the top of the market, the middle of the market, and the bottom of the market. It's always the same. Of course, everybody selling the business has a high price in mind, and every buyer would rather buy it for less. So invariably, in oilfield services, you're desperately trying to close the gap with through clever structures and negotiation, and that's never going to change. So I think buyers are definitely, Matt uses the phrase bargain hunting. I mean, I think that they're certainly very value focused. They're very sensitive about deploying cash. So what the deals that we're getting done are at fair but not crazy valuations, using smart structures, with elements of non-cash consideration, earnouts, nothing that is rocket science, just obvious deal making where you have a degree of pragmatism between both parties to get something done. And I think any sellers wanting to exit their business, and there will be plenty of exceptions that prove every rule, as is always the case, but as a general principle, I think private equity sellers, corporate sellers, and private sellers over the next 3 or 4 years are going to have to recognise that to get deals done, the valuation expectations have to be very realistic.
Yeah, it makes sense. Okay, that's been great. I think we'll move on to our third topic now. So Martin, on the impact of technology, I mean, I suspect we all saw technology within decommissioning as the original movement where technology would really start to play. But now we've obviously got energy transition as well, where a lot of oilfield service companies are starting to realize they're going to have to move and be able to do not just oil and gas, but do other forms of energy and service that. So presumably technology's got a huge role to play in that.
Yeah. I mean, absolutely. What I thought when I was pulling my thoughts together just to kick off our discussion on this topic was to start with maybe mapping some of the regional initiatives that are going on in this space for technology, because they kind of give a flavour of the ecosystem that has developed in Aberdeen in the northeast over the last 5 years. And I think the very fact that it's there is a really positive sign. So firstly, we've got initiatives like OGTC, formerly Oil and Gas Technology Centres, TechX programme, where millions, hundreds of millions of Scottish and UK government money have been put in to sponsor tech companies in the hope of finding these next tech unicorns. And one of the interesting things there is that there have now been 3 annual cohorts of accelerator companies going into that. And they've all been, they start off extremely oil and gas focused. There's a bit of a mix last year with some hydrogen tech in there and clean tech. But next year will be entirely clean tech. And that's coming from the Oil and Gas Technology Centre because of its mandate to get to net zero. So that's a really interesting piece, which I don't want to jump on to Matt's energy transition piece too much, but that's a really important signpost as to where we're heading. And as you said, Doug, we've all seen to put it politely, rebranding of oil services into energy services, but also the real genuine cultural changes that are happening among oilfield services businesses, now energy services businesses. And I think you could be cynical and say that some of that is greenwashing. And I think it was Mike had mentioned earlier, the difference between the IOCs and the NOCs and their essentially government mandate to pursue that agenda as well. But we're seeing a massive amount of capital being deployed from the likes of BP and Total now called Total Energies, totally rebranded for the transition. So I think it's something that's really, really happening. in Aberdeen, the Northeast, in the energy sector. In addition to OGTC TechX, you've got One Digital, Opportunity Northeast, obviously backed by Surrey and Wood. And One Digital is doing a huge amount around soft loans to tech startups in the Northeast. I've got 2 clients just now that are interacting with them, hugely favourable experience. They are also running a sort of mini accelerator, it's called, in the Business Growth Consultancy, where Opportunity Northeast is essentially funding specialist services to these tech companies. They're not necessarily startups, but they're based in the Northeast, committed to building the Scottish economy. And there's 8 companies in that cohort just now, which is great. And then there's Codebase down at School Hill, the former RGU premises, which there's co-working space made available to startups for free. And Barclays have sponsored Eagle Labs, where there's a 3D printer that they can use for free for those that find that useful. So when you actually look at the pieces on the jigsaw, is that the right metaphor? Pieces on the board, there's a huge amount of activity out there and a huge amount of willingness to help. The interesting question for me is then, why are we not seeing yet tech unicorns coming out of Aberdeen, out of the Northeast? What's the missing gap? And I wondered, interested in Matt and Mike's comments on this in particular, because I think one of the big pieces is investment, is capital, is funding, and there's a huge amount of work being done by BP Ventures, by Equinor Venture Fund, Repsol Foundation as well, to try and sponsor in various guises. Some it's an equity play, some it's a grant, some it's accelerator type support, to try and bring on these energy tech companies and transition them and accelerate them. But it hasn't yet come to anything really notable, and maybe that's just a function of time. It may be another couple of years before we see those come through, but I'd be interested in knowing that. And on the what I call the personal investor side, there are now active investor syndicates, private investor syndicates like Alba Equity. Obviously there's Par Equity, a number of others in Edinburgh, or EOS, which are dipping down into that, I guess, high net worth individuals who want to support this kind of investment. And so it's kind of, there's a lot of it out there, but I don't understand why it's not coming together better and producing a lot more activity.
And Mark, when you talk about where are the tech unicorns, you're presumably thinking clean tech rather than.
I guess it could be anything. I mean, yes, I think that is the direction of travel for most businesses, most tech companies now, because for all the reasons that we've spoken about already, that's going to be the dominant mega trend that everyone's trying to address, certainly in energy, but also in non-energy. If we can dip out of our Aberdeen bubble a bit, life sciences, a huge amount of life sciences activity going on, which should and could be able to benefit from all this. We've got 2 universities in the city as well, and I'm not really understanding why we don't have these, why we haven't had more success, given the field that we've got to play on here.
Yeah.
And so I guess my open question is if either of the guys have thoughts on whether that's the investor appetite's different. There's a really interesting piece in The Economist a couple of weeks ago, which was talking about US versus European investment mentality and risk taking, and kind of saying, you wouldn't have thought that America, with its reputation for insipid coffee, would have produced Starbucks. Why isn't it an Italian coffee chain that's taken over the world? Or indeed, you look at EV, electric vehicles. You would have thought that maybe with tighter environmental regulation in the US, it wouldn't be Tesla that's taking over the world. It might be a Scandinavian company. So I'm interested, and I wonder, and the conclusion The Economist was positing was perhaps that's down to risk taking in the investor base, and that the availability of capital in the US is a bit more free. Anyway,
if I may,
yeah.
Yes, it would be nice to see sort of a tech unicorn or several tech unicorns in the northeast of Scotland. You've got Brewdog, which is a tremendous story. Obviously not recently, not so much, but it's not that there aren't tremendously successful companies in this part of the world, but we shouldn't, I don't think, be too hard on ourselves around not producing tech unicorns. I think that the northeast of Scotland produces a lot of excellent companies where, which are with very strong management teams that deliver excellent technologies and growth and financial performance. And I would much rather that be the norm than have a couple of unicorns. Now, unicorns, obviously that kind of lifts everybody's expectations and creates some positivity, but ultimately, for us as an investor, that's not what we're looking for. What we look for is repeatability. We want to make a double out of every single investment that we make, every single one. And if we keep doing that consistently over a series of funds, you will most definitely be top quartile, if not top decile, if you keep on doing that consistently. That's what it takes to be successful as an investor, not so much these unicorns, because it's very hard to predict those. Now, there are some venture investors who have a reputation for spotting those potential unicorns, but that's a different skill set to the one that what we're in the business of trying to do is provide growth capital to good companies and help them become better companies and more valuable companies.
And within your portfolio, Matt, I mean, are you seeing a different approach to technology in these companies, or is it just evolution rather than revolution?
I would not say that it's necessarily a different approach. Certainly different technologies, and value being attached to particular technologies, that changes over time. I think that there is a huge opportunity around carbon emissions reduction, climate change, carbon tech, a huge opportunity for the northeast of Scotland and elsewhere. And I think that the UK as a whole does innovation very well. So your kind of question, Martin, about sort of Starbucks and why wasn't that an Italian company? I think that we can be confident that we will continue to innovate and produce technology leaders going forwards. But we're not the same as America in terms of the capital availability. I mean, that is it's just a bigger market. It just works in a different way. People think differently. Capital, the way that the banking system works there, just the mindset of people in the States, you can't really compare the UK to that and think that we could duplicate that here. That's not what we do.
Okay, excellent. Right, final section, I think. This is this will be the interesting one, I think. Matt, we're on energy transition,
Yes.
Decarbonisation, transition to net zero.
Yeah, so let me talk a little bit about EV, because I think that that's sort of relevant to all of this in some ways. So we are an investor in sustainable energy technology companies. That's the way that we talk about ourselves these days. And so in the past, we have been well known as a technology investor in oilfield services. I think Mike would probably agree with that. And we've raised about $1 billion, and we've invested that in around about 60 primary investments over the last 20 years. All energy, all technology companies, predominantly oilfield services. But for the last 2 years, we have specifically excluded investments in oil and gas, in the oil and gas value chain, specifically excluded after whatever it is, 18 years of looking at oilfield services technology companies. We've stopped doing oil field investments, and that has required us to really have a pretty hard think about where our business is going. And of course, we're a private equity investor, and that requires us to raise money from institutional investors to invest directly into companies. And one of the reasons why we've had to rethink is because we see a tremendous opportunity in sustainable energy technology, in technologies that help carbon emissions reduction. That market is red hot at the moment. There is a huge amount to look at. Doing a huge amount of work on new opportunities. Pricing is very different. But I would much rather pay more for a business that I know I can sell with confidence within a sensible time frame, 3 to 5 years is what we're usually looking at, than where I worry about, the potential buyers for a business, which is, we've still got 20 odd portfolio companies in the oil field, and I do worry about how, ultimately we the runoff of those investments. So, we look forward and we see a big opportunity in climate change, and we feel better about directing our energy toward that net zero goal. It's super, super important. So there's, we're still a growth capital investor, so the playbook is still the same, but the market opportunity has shifted toward renewables, grid and storage, and energy efficiency. We've looked at hydrogen. Not very comfortable with that as an investment theme, but that might change for sort of various different reasons. So, I think it's been a very interesting discussion. I think the big question for us is around, the big question for our investors is around not just the next 5 years, but the next 15 years. If we're out there raising a fund, we're talking to investors and we're looking for cornerstones. They are asking themselves, okay, well, so we can invest with these guys. They seem to know what they're doing. But if we were trying to sell a story around the oil field, those investors are asking themselves, all right, so okay, well, so the market, maybe it's coming back, maybe it's tightening up, and maybe that takes care of things for the next 3 to 5 years. But what about the fund after that? What about the fund after that? So can I look forward and see 3 or 4 funds worth of opportunities here? Because, that's what I need to see in order to get comfortable with investing in this fund. And it touches on what Mike was saying about terminal value and the overall sort of sentiment toward the hydrocarbon business. And investors are saying to themselves, I'm not really sure. And of course, they can put their money elsewhere. You talk to them about carbon emissions reduction and climate change, and that as a macro trend, and they are much, much more receptive and interested in that. And I'm glad about that.
It strikes me that we're missing transition, though, in that are there not lots of business? I read somewhere that 65% of all oilfield services businesses are going to be transitioning towards clean energy over the next 3 years, and have the majority of their turnover within clean energy rather than fossil fuels. Is there not a sort of
potentially, and maybe that, and you've seen some examples of that as an arbitrage opportunity, where if you're able to successfully transition from it being from a company being an oilfield services company to something which is dedicated to offshore wind, there's maybe a value arbitrage opportunity there, and there's been a few examples of that. But I don't necessarily think that we should assume that the hydrocarbon industry, the sort of dominant players in the hydrocarbon industry today will become dominant players in the new energy industry of the future. I think it's reasonable to assume that there's a different skill set required.
Yeah.
And I think that, markets aren't necessarily rational either. And that there's a, and also that some of this becomes kind of self-fulfilling in that, because of what I was just talking about investment appetite, that there is an industry over, a new energy landscape which is being funded. There is a huge amount of money going into that, and as a result, less investment in traditional hydrocarbon business, despite the tightening which Mike was talking about. And despite the great technology and track record and competence of management teams and all of those sorts of things, that isn't necessarily enough for investors to say, that's where I want to put my money. Yeah. Even if, returns from, an offshore wind farm or a solar farm, whatever, are not, not comparable.
Yeah. It's interesting to hear you say that, Mike, because it's slightly different message from the one I was expecting. I thought it was going to be based about investor sentiment and regulation to net zero. But actually what you're saying is that the actual opportunities for future exit and profit will actually outweigh these negative sentiments. There's a positive message there.
Yeah, I think there's carrot and the stick. I mean, you've got SFDR, which Sustainable Financial Disclosure Regulations, which addresses this concern around greenwashing. And SFDR is having a huge impact on the financial services industry. That's politicians trying to legislate to generate clarity around carbon emissions and investing, and financial investing in, just generally to create clarity around, as I say, carbon emissions. So that's the stick, so SFDR Article 6, SFDR Article 9, those are things that financial investors, banks, financial institutions, pension funds, and so on worry about a lot now. So that's relatively recent. This is all sort of legislation which has come in over the last 12 months, and the financial services industry is trying to get its head around that at the moment. But one of the levers that politicians are trying to pull is the capital flow, and trying to find ways to direct that toward things which are consistent with these net zero targets, which they're committing to.
Okay.
And also you're seeing investor sentiment. I mean, it's the Belgian court requiring Shell to reduce its carbon emissions by 45% versus 2019 levels by 2030. If that's left unchallenged, that is a, oh, crikey. If I was part of Shell's leadership team or board, I'd really be scratching my head now how they actually deliver that. As you're talking about, that scope 1, scope 2, scope 3.
Yeah. Okay. Well, let me just throw it open to the others, and for any final comments around that. We've got a few minutes left.
I maybe ask a question that follows on from Matt's observation. So I completely understand if you're sitting as an investor and you've got to deploy your capital, then the clean tech / green option has the greater longevity, and understand the mega trend reinforcement of that. What does that mean for the conventional oil field services businesses that we have? I mean, Mike spoke earlier about the deal market. That obviously means M&A activity might be difficult because of the terminal value problem. Where does that leave them then? Does it mean that they just have to, those that can pivot into energy services more broadly, offshore wind, whatever, do that, but fundamentally they're going to run out of road? Is that your kind of view?
No, I mean the hydrocarbon business is not going to go away, but I think the energy transition will happen faster than we think. Just like I think we're going to see more electric cars on our roads far faster than we think too. You know, our belief, our view of the future is based on the past, and I think that we're going to see a very rapid and very large transition happen very quickly. That's my personal view. And so oilfield services companies, you know, need to be careful that their thinking is not anchored necessarily in the past, that they form a view on the future and adjust accordingly. And I think, you know, companies that are able to make that those changes or adjust more quickly are going to be more successful. Sorry, go ahead.
Mike, any closing comments? A couple of minutes left.
Didn't mean to interrupt Matt in full flow. I'm enjoying listening to what he's saying. You know, I was just it was just to the point, because I realised I think you should add an extra hour to the next time you do this webinar, because there seems like a lot of things that we could talk about and haven't had a chance to do so. But I think, you know, look, I absolutely, and our firm completely agrees with the overall sentiment that, you know, however you want to define it, whether it's energy transition or net, you know, path to net zero, whatever, that is an accelerating trend that will change the landscape forever, right? So it's a mega cycle that we're beginning of, and if, you know, speaking professionally, at no point in the time I've been in this industry have I faced a bigger opportunity to be part of something, you know, fundamentally, you know, game changing as the energy transition journey that we're about to embark on, because there are massive capital flows coming into the industry. The cost of capital is really low. There's a real hunger to invest in projects and create supply chains and adopt technology, and that creates a great opportunity. And we're very much focused on that, as well as staying faithful to our oilfield services past. I think the thing I wanted to touch on for a second was how successful will the oilfield services businesses be in making the transition? And I actually think they'll be more successful than some people believe, because they, you know, many already are. And, you know, look at the scale of the oilfield services industry. You know, multi-billion-dollar organizations, global footprints, the best engineering talent, the best technology, access to capital. Schlumberger's shrunk from a peak $130 billion of market cap back in the day to something like $45 billion. Don't quote me on that, but when I looked last week, $45 billion of market cap. You know, huge organization, massive power. Yes, you know, they themselves, and I don't have any insights, you know, deep insights on what Schlumberger are doing. Of course, they'll be wrestling with transition, and they have their own initiatives in a few directions. It's a challenge for a Schlumberger, because it's your classic, you know, how do you move a, you know, how do you move a vast ship in the ocean and change tack, you know, when substantially all of the revenue comes from oilfield services activity. But for larger, you know, for mid-cap businesses, they're well and truly on that journey, you know, and you know, but Technip was mentioned, you know, Subsea 7's mentioned. I mean, I could reel off. We're having exciting conversations with NOV on a number of things. Just, you know, give them a name check. You know, these guys, nobody's standing still. You know, and they're moving at real speed. Offshore wind is the industry that looks most exciting for a very obvious reason. That's where the dollars are being spent. You know, these are real projects that are attracting real real investments now, whereas, you know, carbon capture and storage and hydrogen are good examples of things that are out there and much more nascent. How do you play carbon capture and storage from a services perspective? Not obvious how you do that, because none of the projects are moving forward at pace yet. But offshore wind is massive, and it's going to become bigger, you know, but magnitude bigger over the next 5 to 10 years, and going to become a global market. So I think the oilfield services companies of today become the energy services companies of tomorrow, for a whole host of reasons. And they're all changing slightly different ways, because they have different strengths and their skills apply in different ways. So contrast Baker Hughes with Halliburton, you'll find them in a different place in 15 years' time, but they'll both be very successful businesses.
Well, that's a very good note to finish on. So thank you very much, all, and thank you all that have been listening. And I think that is it. We will call it a day. Thank you.
Thank you, James.
Thank you.
See ya.
Thanks, everyone.